Welcome, everybody. My name is Jeff Green, president of Green Team Realty. Thank you so much for joining us for the April 2020 housing market update. Boy, what a crazy time we're living in right now. A lot of economic turmoil, a lot of health crises going on with the pandemic, COVID-19. We have a lot of good information for you here, a lot of historical perspective to help us manage our emotions as to what's happening with the housing market, what's happening with the overall economy. We have a great panel set up, so let's get right into it. I'm going to screen share right now and take a look at some important numbers that will help us do what we need to do and navigate this the best that we can. So the big question is this going to be like 2008? What's significant about 2008 for some of you who may not know? Well, that was the start of the Great Recession, as we call it, right? And the housing market update was really impacted significantly because it was really the problem, the catalyst that caused the Great Recession, okay? So let's take a look at that question. Is it going to be like 2008? Well, we've been looking at this slide for some time. If you've been, watching the housing market updates for the last couple of months, you've seen this before, where recessions don't necessarily impact the housing market, okay? So when you take a look at the last 5 recessions, this is what has happened to housing prices. So 3 out of the 5 prices actually increased through the recessions. So not necessarily a direct impact on pricing. So what about the mortgage industry? Okay. Now, when you take a look at 2007, 8, and 9, the annual home price depreciation was pretty significant. But again, that was because we were dealing with, subprime lending, so on and so forth. There was a major correction that happened both in the stock market as well as in the housing market. But when you take a look a little bit further back to the .com and the 9/11 crash, you can see that there was a pretty substantial S&P stock market correction, if you will, but yet prices in the housing market continued to increase because there was good fundamentals in place. So then we take a look at annual home price appreciation, right? Which is important because in any marketplace, you have to look at overall values. Are assets undervalued or are they overvalued wherever you are? Okay, now clearly with the run up into 2008, 2000 through 2005, there were major price increases year over year. I just skipped ahead there mistakenly. 8.6%, 6.5% was the lowest annual increase in that 6-year stretch. The highest being 12.5%. You can see from 14 to 19, we never even got to 6.5% in any one particular year. So that means that the pricing was tempered, and that's because we never did get into a large subprime lending situation where everybody was able to get a mortgage and so many more people were able to come into the marketplace. It was much more tempered because of the way that the lending practices were happening. You take a look at the months of inventory of homes for sale in 2007, there was 8.2 months of inventory. And right now there's 3.1 months of inventory. What does that mean? It just means that the market's a heck of a lot hotter now than it was back in 2007, leading into the Great Recession, okay? So the point is that the Great Recession required a mortgage industry restructuring, all right? And that ultimately led for a lot of buyers to be out of the marketplace altogether. They weren't able to get loans. Good buyers during that hard time couldn't get mortgages. It was very challenging for them to get it done. Totally different landscape this time around, okay? Because we didn't have this subprime lending bubble in the residential housing market. That didn't exist. So, loans are going to be able to be, processed for good buyers who have good credit, so on and so forth. Now, are lending requirements tightening a little bit? Sure, that's always going to happen, but not to an unreasonable level where we're not going to be able to get it going again. So here's just another analytic, another chart to look at that very issue. So here's the housing bubble in 2006, okay? It crashed. And this is a relation of, the mortgage credit availability. So how many people, how much availability was there? You could see how much availability there was in 2004, 2005, leading up to the crash. But look at where we stayed this whole time through this last period, right? From the crash and the Great Recession all the way through. I've been saying for a long time, the silver lining to where we are now is that the banks are making money. The banks they've been making good decisions with their loans, which means that all of the mortgage-backed securities are in pretty good shape. All of the money being invested into the mortgage market as a whole is in pretty good shape because good decisions have been being made on the individual level. This is what this line shows you that, okay? This is also another very interesting fact. Look at this. This shows the total home equity cashed out, okay? One of the telltale signs of where we were in 5, 6, and 7 versus where we are now, 17, 18, and 19, was that people were using their homes like an ATM. We've all heard that phrase, right? That was happening on a big level. But look at how much less leverage has been put on people's homes during that time. Almost 1/4 of the amount of equity being pulled out. 53% of all homes in America have at least 50% equity. That's a really good mark. That means that a lot of personal balance sheets are in good shape. Okay, and then this tells us, you know, the median income needed to purchase a median priced home. So affordability, right? So affordability is in much better shape, almost twice as good, right? Almost twice the affordability level as it was in 2006, right before the market crashed last time. Now, why is that? Prices rose, so on and so forth. Well, the money to be able to borrow to buy a home is very cheap. You know, mortgage rates are very low, so affordability remains very good. So what about jobs, right? This has always been my thing, jobs, 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 right? It's very important. I think it is, there's no doubt that we can, you know, say that with a good job market, the real estate market should follow and the real estate market should be strong as well. But I want to share some stuff with you that I learned. Okay, that's interesting. So here's a breakdown of the U.S. Of the jobs that were lost, essentially, that people claimed for unemployment in different sectors. And this was as of April 3rd. You can see over here that the next set of numbers is to come on May 8th of 2020. And so for next month's housing market update, we're going to have an update on this very slide here. But 59.5% as of April 3rd. Now, there have been many more unemployment claims since April 3rd. The last, you know, 17 days, right? Because today's the 20th, the 3rd, so on and so forth. Food services and drinking places, right? 59% of the unemployment claims have come from there. And then you take a look at, you know, the accommodation industry, retail and trade, temporarily help services, child daycare workers, healthcare office workers, construction workers. The point that I'm trying to make here, and the point that this graph makes, is that these jobs are going to come back, and they're going to come back pretty quick as soon as these businesses can operate again. Now, I think we all can agree that restaurants, it's going to take some time. You know, it's going to take time for people to feel comfortable to get back out there in the general public and sit down and have a waiter come up and serve them their food, right? It's going to take some time for people to have that confidence. But little by little, day by day, we're getting there, okay? And these jobs are going to come back. The only other sectors that may be more permanent job losses only account for 9.8% of the total job unemployment claims as of April 3rd. Now, we may see a major increase in this 9.8% in between now and the next release of these numbers on May 8th. But for now, it looks like there's going to be a big snapback of employment when the economy's open back up again. So here's another interesting chart about how unemployment rates and home sales, their relation to them, you know, their relation to one another. So the orange line here that you see, gold, whatever you want to call it, is the unemployment rate, and these blue bars are home sales, the number of home sales. So you can see that, you know, as unemployment rose back in the late 80s, early 90s, the housing market just kept going. You know, it kept going and kept going and kept going and kept going, and it peaked here in 2005. This is the number of homes sold, okay? And then it crashed, and so did unemployment came up. So there's a direct relationship, right? Where I guess you would almost call it an inverse, right? This came down, that went up. But the idea is, yes, it did. Unemployment rose, but so did in housing, the number of home sales crashed. So there you can say, but look at this, right? Look at the decrease in the number of job unemployment claims. Okay, the unemployment rate came way down, but we didn't see a major spike, you know, in home sales. I mean, you could almost argue that these 4 or 5 years here were pretty flat. So there wasn't necessarily a massive run up in the housing market, despite the fact that the unemployment rate was at historic lows. So the point is that you know, it doesn't necessarily mean just because the unemployment rate is going to rise and it's going to be higher than what we've seen in a long time, it doesn't necessarily have to make a major negative impact on the housing market. Now, this is interesting. Check out the unemployment rates during the Great Depression era, 30 through 35, 8.7, 15.9, and then all 20s going forward, okay? This is a chart given by Goldman Sachs. They're projecting 2020 to have a 15% unemployment rate, which is god awful compared to where we were and where we want to be. But they're also projecting that 2021 is going to be somewhere between 6 to 8, and then things are going to pick back up again and drop back down to, you know, a much more robust job marketplace come 2023. So am I going to sit here and say that, you know, we're not going to be economically impacted in the housing market? No, of course, that would be foolish to say that. But I don't think that we should be chicken littles and, you know, go nuts about, you know, the impact of everything that's going on. So this is a true statement that I've been hearing a lot of economists talk about, and I think I'm buying into it now, right? That it really is more, this is more of a natural disaster than a recession as to what's happening with COVID-19. The problem is how long is this natural disaster going to last? And I think that's what no one really knows. And that's what you know, what we're concerned about is, all right, well, how long is this going to shut down the economies? When we start to open up again, are we going to see spikes in the number of cases? Are we going to see deaths spike again? What does that mean? Are we going to have to contract our economies? Are we going to have to pause once again? You know, there's a lot of unknowns here, but needless to say, in each of these situations, there was, you look at post-Katrina in Louisiana, a major, you know, decrease in the jobless claims as time went on. Now down here, this blue line, that's the path of the US economy in the Great Recession, where you didn't see a major spike or a major decrease. It just kind of, you know, moseyed along. So really what we're seeing is much more consistent with a natural disaster. So let's take a look at some numbers nationwide from the NAR here. We're not going to spend too much time on local numbers, but I wanted to give some more perspective here. So there's not a whole lot to glean from this slide here where we're showing year over year existing national sales. As you can see, the market was hot, right? It was going up and up and up, and prices continue to increase. Now, as it'll be interesting to see what these numbers flesh out to over the next 90 to 120 days. You know, will this line dip below previous years? We're going to keep an eye on this and show you guys, but this is what I wanted to show you. All right, because a lot of what we're going to discuss when we get to the panel in just a couple of minutes is, should a buyer buy and should a seller sell? Because at the end of the day, that's the bottom line. That's what people want to know. What should I do? You know, we need a house, but we don't want to buy now because we're afraid prices are going to fall out the bottom, so on and so forth. Okay, so look, here is a look from 1999 to 2020. Okay, this is a 20-year look back on average home price in the United States of America. And even if you bought at the peak of 2007, 2008, where prices right here was about the height, right? And that's the summer of 2007. So if you were somebody, and I'm raising my hand, I don't know if you can see me, but I'm raising my hand. I bought my house that I'm standing in right now, running this meeting from, basically I contracted it right at the peak, right before things dropped in 2007. Okay. Yes, it went sideways, but it didn't take all that long for one of the worst periods of the real estate market, okay, in history, for it to recover and to get back to where it was. It took 8 years. All right, that's a long time. But a lot of people, the average always historically for how often people move has been about 6 years, historically over the course of decades. That has now inched up. It's now inching closer towards 9 years now. So the average homeowner is not going to buy or sell during a period of, you know, of up or down. They're going to be able to last long enough so that they can gain some equity in their home. And then, of course, the other the other argument is, all right, well, if you don't buy, what are you going to do? You're going to rent. So now you're paying rental dollars to a landlord. You're not building equity. You're not getting tax write-offs, all these other benefits from home ownership. So I'm going to make the argument that now is actually a very good time to buy, and it's actually not a bad time to sell either, because inventory levels are so low. So on that note, here are the months of supply of inventory on the nation as a whole. So historically, 6 months of supply and inventory is historically an average market. We have been way below that for some time. In fact, we're down to 3 months of inventory right now. Honestly, I don't see this number climbing anytime soon. I think that this number is going to stay pretty low, because what's happening right now is a lot of sellers are not putting their homes in the market because they want to see where things are going to what's happening, you know, with the marketplace, so on and so forth. And you know, I'm not necessarily going to say that's a mistake, because everybody's got to make their own personal decision, but I don't necessarily think it's all that smart to not, you know, put your home on the market right now, all things considered. I think, you know, there's a lot of decisions that need to be made that go into that right now, but inventory is low. So we take a look. I'm just going to show you these for locally. Orange County and Sussex County will look, because it's going to be interesting to watch the 2020, the green line, over these next 90 days. What's going to happen to units sold? You know, you can see it actually was better in March than it was in February. You know, I mean, closings on the books, you know, wasn't much, you know, happening during that time as far as COVID-19. So we're going to start to really see things reel back here. But it'll be interesting to see the bounce too. Average sale price way up. Then you go down into New Jersey and you take a look there. And again, once again, you know, we're kind of coming out at a good solid pace, and we'll see what the next months bring here. All right, so some housekeeping items, and then we're going to get to the panel. So the next housing market update is going to take place on May 19th at 2 p.m. Again, we'll have some more updated numbers from the Labor Bureau, so on and so forth. You can always follow us with what's going on with the housing market update. Get you know, invited to the webinar so that you can ask questions live at that link there. And then a thanks to Really, the business referral community, for being our sponsor. Really is where business professionals can connect, communicate, and securely exchange referrals with speed and ease. You can join for free at reallyhq.com. So let's, without further ado, let's take a look and say hello to all of our panelists. So you guys can unmute your mics right now. I'm going to go to gallery view so we can see everybody. So Ken, how you doing, Ken Aulicino? Not Ken Flood, Aulicino from Family First. Just give us a wave so everybody knows who you are and can see you. There you go. Vikki Garby from Green Team New York Realty, excuse me. Carol Buchanan from Green Team New York Realty. How you doing? Keren Gonen from Green Team New Jersey Realty. And Ken Flood from Quest Financials. Ken is a financial advisor. Ken Flood is a financial advisor. All right, everybody. So thanks for bearing with me there. It took a lot longer than I normally do, but there's a lot to share, a lot of information. So let's start with the real estate brokers, real estate agents that we have on our panel here. Vikki, I see you up top. You know, you and I were going back and forth. You know, you attended a webinar by CoStar talking about the commercial market and how commercial real estate was going. Do you have any thoughts or opinions on what's taking place right now?
Well, on commercial specifically, or on residential?
Both.
Both, okay. So commercial obviously is slowing down a little bit, at least until we kind of get our feet out from under us and figure out when jobs are coming back. One of the interesting things that they talked about was how we're all working virtually right now. And one of the things that they're trying to predict is that going to happen more and more in the future, where for example, office space square footage per employee is going down because of the flexibility people are getting to work from home. So I guess it's hard to do a blanket statement. You know, industrial space doesn't have that same impact. You know, you need warehouse space to push inventory and, you know, hold supplies. I think right now, because of the job market, you know, people are a little bit shy to rent a new space, maybe for a small personal business that they own. So I am seeing that. But on the residential side, you know, obviously you talk about inventory being low, and the way realtors are working out there is different because we can't show clients in person, homes in person, but the whole industry is just adapting to be able to move, homes virtually. Obviously, sellers are being a little bit more involved in showing their homes, but I have called numerous agents who have listings in the 600,000 range, which is not typically our, average price point up here in the Hudson Valley. And they're getting offers. They're getting offers on homes before people are even stepping foot into the home, of course, contingent on them eventually getting into the home, doing inspection. But the low inventory is really driving movement. I think a lot of people are trying to get out of the city right now and are still looking in the Hudson Valley and surrounding area. So, I second what you said, that it is a pretty good time to sell. For the past few weeks, it's been a little bit scary maybe, and people were trying to see how we're going to adapt, but we're adapting, little by little, and people are certainly selling and moving properties.
Yeah, Carol, I mean, I would have to imagine that you're still seeing activity, right?
Absolutely. There are buyers that are eager to get out there and start seeing homes. They are currently looking at pictures and virtual tours, but they are definitely interested in looking at homes. And I have several listings that people are eager to put their homes on the market. We just hold them back a little bit just to see how things shake out. But like Vikki said, I'm also seeing homes that are up there in price. And surprisingly to me, they are coming in with offers. So the market seems to be holding its own.
Yeah, which is remarkable. I mean, it's certainly not the intensity that we're used to, but transactions are trickling through,
Yeah,
and
it's
people
going well.
are, we are a resilient bunch, us human beings,
Yes.
like we figure things out. That's why God gifted us intelligence. Keren, what about you? I mean, you're probably one of the more fierce realtors that I know. You haven't stopped an inch from everything that's been going on. You probably have a mask on you and gloves and everywhere you're running around doing whatever you got to do. So are you seeing that transactions are still getting done?
So for me, I can definitely say that the buyers that do want to go out and look are 100% ready now. I don't have those people that are looking to see 15, 20, 100 houses like I normally do around this time of year. Everybody that I've taken out so far, it's one day, 4 or 5 houses. We go and put in an offer, get under contract, and finish them up.
Yeah.
So people are still able to move, except now only the serious ones are out there. You don't have the browsers as much.
Yeah.
I do have a few sellers that are holding back because they want to wait just a couple of, possibly weeks, hopefully, instead of listing now. But people are ready. They're still buying, and the sellers still want to sell.
Yeah. It's almost as if it's like the holiday time, like no one really wants to put their home on the market because they won't, they're prepping for family and they're decorating the house and they just don't want to bother. And a lot of buyers aren't looking. It's kind of what it feels like, it's almost that level. It hasn't stopped, but it's just at a lower level. But the other thing I can say is I'm hearing stories and reading reports and talking to people around the country, other brokers and agents, and things are moving. I mean, they're not really stopping now. We happen to be in the epicenter of this thing here in New York and New Jersey. Like we are literally ground zero of this pandemic. So I think we're being hit a little bit harder for sure. But I still think there's even still within our situation, things are getting done. That's the point. And I don't know. I mean, if I had to sell a house right now, I would have it on the market because there's not a lot of competition out there. That's the bottom line. So whatever buyers are out there, they're serious and they're going to come, check in hand, ready to go. All right. So let's transition over to Ken Aulicino. We're going to come to you next, but Ken Flood, let's check in just on the markets. It's been fascinating to watch what's going on with the stock market. I mean, it basically imploded, massive decrease, nice rebound. The Dow got all the way back up to 24,000. I haven't watched the Dow, what's going on today. I know we lost some ground yesterday, but Where do you see markets going? I know that back in '08, Great Recession, there was a crash, there was a rally, and then there was another crash, and then it finally took off to its current trajectory. So give us your commentary on the financial markets.
Well, what we saw back in late February into March is we saw the credit markets getting hit. And then followed by that, you saw the stock market come down. The Fed came in and shored up the credit markets, and the government is putting a lot of stimulus into the economy and into the stock market. So that's that rebound that you mentioned when we kind of bounced back in. One thing that you had said earlier that made a lot of sense was, I think it was a Goldman Sachs that you quoted, that it's more of a natural disaster, so it's a healthcare crisis. So when you look at other bear markets, and you'll see bear market rallies and then it'll sell off again, that was really economic crisis. So we really don't really have any guidance on what's going to happen with a healthcare crisis.
Right.
So that's been a little bit of a problem.
Because we've never been through it, right? I mean,
exactly.
You could talk about SARS or this, that, the other thing, but it didn't really hit us like this.
No.
This is uncharted territory. Yeah.
Right. So, you're looking at, normally when you see a really strong stock market, you'd see yields go up on the 10-year treasury. Right now they're down at like 55 basis points. And today the market's off, 461 right now. So you have, 2 days where it's down. The volatility index is up a little bit today. So you're coming into earnings season. The earnings are probably going to be poor. There's no guidance from companies. So you could possibly see a little bit of a downturn right now. The positives that I would see, since there's a lot of money put into the market by the governments on the bond market, credit, and then the stock side, you're less likely to see a lot of failures and bankruptcies. So hopefully, pushing out 4 or 5 months, we might start to see a stronger economy.
Right.
If you've seen where oil prices are, they're getting hammered because there's a backload of oil. Nothing's used. So it's almost kind of like the economy is on hold. The government propped it up, and now we're waiting to see, can we reopen the economy? And I think if we can reopen it, in a positive way, not just reopening it, we could put people back to work, and hopefully in 2 or 3 quarters, start to get the unemployment numbers down and better guidance on earnings per share from companies. So like the last few days, companies that reported gave no guidance.
Something interesting about oil that I learned recently is that the price of a barrel of oil and everything that's happening right now with production and a lot of the reasons why Saudi Arabia and Russia were playing chicken with each other on reducing production is because to close down a well is a major expense. To not necessarily close it down, but to reopen it, so there's a huge amount of money, capital cost that needs to go into reopening a well that has been shut down. So, slowing down production is a big thing. It's not easy to do. But what happened was, Saudi Arabia and Russia, I'm not going to go into the whole story, but they were at a standoff, and Saudi Arabia actually increased production just at the exact wrong time. And then what happens is, now what the issue is, they have nowhere to store the oil that's coming out of it. There's literally nowhere to store it. There's, they've filled up all of the overseas ships, these massive ships that are so big they have a hard time fitting through the Panama Canal. They're all filled. There's no more ships left. They're all just literally sitting in the water. There's millions and millions of barrels of oil sitting on the oceans and on, grade storage tanks. So they literally have nowhere to put the oil. So, and Ken, you correct me if I'm wrong, but ultimately the problem with that is that the banks are financing the oil industry just like they are any other. So, we need the banks to function properly for any economy to run. So that's really the risk with oil, is that if it gets so bad that all these companies are just going belly up, the banks are going to get hit real hard. Is that accurate?
That is. This morning, the Trump administration did come out and say that they would back some of these larger oil companies to try and prevent what you're talking about.
Right.
So we'll have to see where that ends up. That was just something I had read this morning.
Yeah, and it's easy for people to get all huffy and puffy about the government money going to oil companies, but you have to understand the nuances behind it. and why these administrations are always backed into the corner and have to do it, because they can't just allow the banking system to implode on itself. And we do need energy, at the end of the day. We
Yeah,
do.
right.
So, all right, that's good stuff. Thanks, Ken, for that. So Ken Aulicino, let's hear about the mortgage industry, man. There was it was frightening there 2 or 3 weeks ago when what happened was, as part of this, financial aid package, essentially the Fed came out and the federal government came out and said, people can stop paying their mortgages. And then there was an unbelievable amount of forbearance requests, and people just stopped paying their mortgages. So that was putting a huge amount of pressure on the banks, but also the bondholders of the mortgage-backed securities, if I'm saying that correctly. Is that accurate, what was happening?
Yeah, that is correct.
Yeah.
The FHA loans are now, they have a forbearance program in place for FHA programs. One of the biggest issues is it's with the banks, but it's also with the servicers, the mortgage servicers. Even though the government is allowing homeowners to skip payments, the servicing companies still have to make those payments to the investors.
Right.
The servicing industry went to the government and said, hey, we're going to need some help here.
Yeah.
So the FHA loans, the HUD-backed loans, have something in place for that. And right now, the GSEs, the Fannie Mae and the Freddie Mac, they're actually in the works. I actually read something this morning that said that the Federal Housing Finance Agency is allowing them 4 months. Fannie has to pay principal and interest, whereas Freddie's only has to pay interest only. And after that, they're not responsible. One of the big problems with this is that they're not requiring homeowners to show the need for the forbearance.
Right.
And,
that's the issue.
Experts.
Yeah, people are just doing it.
Right. So, getting back to the interest rates and to the mortgages and stuff, our rates were dropping significantly up until the beginning of March. And, we had a big refi boom. And then when the Fed stepped in and dumped, $700 billion into the federal government, that wreaked havoc upon the bond market, both the MBSs and the 10-year bond. And right now, the rates are all over. We pretty much have lost a good portion of our non-QM market and our jumbo market. Investors, but a lot of those will be back. So, your bank statement programs, your DSCRs, a lot of the companies that we work with, a lot of the investors have put that stuff on hold, but they're slowly starting to come back. So, but
that's good. So I think that the bottom line is that we were really unsure about what was happening, but the storm seems to be settling. People are kind of finding their sea legs, so to speak, to continue with the storm analogy. And we're kind of moving forward cautiously, but we're moving forward. Is that?
Yeah. Many of your bigger banks, you probably heard that Chase has put overlays in where they won't take a loan for less than a 700 FICO score with a 20% down. Not too many banks are following suit with that, but many banks are being extremely cautious.
Right.
FHA is, I'm not going to say not accepting, but they're scrutinizing anybody with a credit score below 620. Whereas before we could go to 580 without a hiccup.
Yeah. Okay. All right. Well, I think that the takeaway is that we're finding a path forward. All of us individually. Brokers are doing it. Mortgage bankers are doing it. Financial advisors are doing it. The government's doing it. We're just trying to find a way to persist through this whole thing, right? And somehow, some way, it's working. Hopefully we can get more people back to work, so we can, eliminate the strain on businesses, unemployment, government, the whole thing. So we'll have to see where it goes. Does anybody have anything else they want to add before we wrap it up here?
I do.
Go ahead, Keren.
I actually just wanted to remind everyone that yes, we are dealing with a crisis with the housing market and just in general. This is a really great time for us to look out for each other. So I have people that are calling me for houses, and then we end up talking for 45 minutes about life in general. So I just ask that everyone be patient with each other. And if a client wants to talk to you for an hour just to alleviate their stress, take the time, because they need it too. So let's start thinking about other people's needs and not just ours.
Well said. Very well said. Okay, so let's just real quick, real fast, everybody go through. I'm going to leave speaker view up so everybody can see you. We'll start with Ken at Aulicino. Tell us how people get a hold of you, Ken.
I actually have my cell phone is 973-903-1927. That's on me 7 days a week. And I just wanted to say that we're a direct lender. We are still doing mortgages, and we're doing them. We're actually having the best month we've ever had. I think that's the best way. If I were to try to give you my email address, it's my name, and it would just be a mess.
All right. Very good. Thanks, Ken. Carol Buchanan, go ahead.
I can be reached at 845-705-9162. And I'm still optimistic about the housing market.
Very good. Thanks, Carol. Keren Gonen.
My number is 551-262-4062, and you can always reach me at my cell phone or through Facebook Messenger. I'm also available on Instagram.
All right. Ken Flood.
My phone number is 845-527-9437. And the email is ken@questfinancialservices.com. Thank you.
Very good. And last but not least, Vikki Garby.
Cell number is 201-213-9818. Text or call anytime.
All right, everybody. Thanks for coming. We'll see you next month on May's Housing Market Update. Until then.